Hey everybody, Chris Musto with Guaranteed Rate. Wanted to talk today about getting a mortgage when you're self-employed. So a lender considers you to be self-employed when you own 25% or more of a business. And it can be tricky to get a mortgage when you're self-employed because most self-employed business owners tend to have a lot of write-offs. You write off as much as you can to pay tax on as little as possible that's left over. I get it. That's the object, and perfectly legal when you do it the right way. But when you go to get a mortgage, that small amount of net income can work against you. So most lenders will want to average your last 2 years of tax returns. So this is personal returns, business returns, and they're going to look at your income after your expenses. So on the first page of your tax return, you can look and see what this number is. It's going to be your adjusted gross income. This is going to give you kind of an overview of all of your income, but that's kind of a good ballpark to look at. So the last 2 years. A couple of red flags to look out for is if your income goes down from year to year, you're going to need a good explanation as to why. Now, sometimes you have one-time expenses that the lender can exclude. There's also things that we can add back in, some of your expense types that we can add back in, like car mileage, depreciation, sometimes if you have carryover losses from other entities, that sort of thing. But for the most part, it's going to be based off of your net income average for the last couple of years. Sometimes we can get by with 1 year of tax returns, but it's typically 2. Now, that's how you get qualified for a traditional type of mortgage. If that is not going to work, we've got some alternatives that we can look at. One of the most popular ones that we have access to is another way of qualifying you for a mortgage, and we call them bank statement programs. So what this will look at is, instead of averaging your tax return income, we don't need the tax returns. We would look at the last, say, 12 to 24 months of bank statements, and we're going to look at the deposits coming in. So these can be coming into your business accounts or into your personal accounts, but they have to be consistent and easy to track. Now, they don't have to be exactly the same every month. That's not likely, but we'll take an average and calculate the income, and this is another way of getting you qualified. So that may be a better way to go. We may be able to get you more income that way to be able to get you into the house that you want. So a couple of things to keep in mind for that program, those different types of bank statement programs, is you're going to need at least at a minimum 10% down. The rates are also going to be a little bit higher than they would be on a traditional mortgage. So, but you can also offset that by putting more down, but it's going to be at least a minimum of 10% down. And credit needs to be excellent for those as well. So hopefully this is helpful, and feel free to reach out to me if you have any questions. Either want to look at what you qualify for now, or if you want to put together a plan for getting qualified to buy down the road. Again, this is Chris Musto, and thanks for watching.